All right, and
All right, so one of the things you guys didn't mention in your presentation was just you spent a lot of time was the growth of production. What's the CapEx need for the company for the next 5 years to get that fully up to spec?
We're projecting 16% as a percentage of revenue going forward. We think that can sustain that revenue growth going forward. A lot of that will be that new mill. They've estimated at like $8 to $9 million of expense, and then the drilling and other expenses will also add up to that. But this year the company spent, I think, was it $3.4 million. So they've also front loaded a lot of the CapEx needed to meet those new production requirements going forward. And the company's production expectations going forward, like I said, that was based on a 2-3-year plan to reach 20 to 25,000 ounces of gold, and a lot of that will take about a year to hit online. So that's why we see more of an exponential curve as those new assets become producing later on in the schedule.
Okay, so $9 million for the mill. Is that the CapEx need for next year?
And then that'll be dispersed at 16% for revenue over that time period, so the CapEx will grow as the business grows.
Okay, and how are they going to fund that? In the last 3 quarters, the most recent 10Q, at a negative operating cash flow. So how are they going to fund that CapEx?
A lot of it will come from continued shareholder dilution as they seek to raise funds through there, but also convertible debt has been a very popular option for the firm in the past. In Q3, I think their current assets decreased by $2 million due to the acquisition of that new property, so they will have to raise funds in the near future through private placement or some other method. We're projecting that this will stay relatively consistent. It has in the past. There's not a lot of variation in shareholder dilution looking back at even further years because the core operations of the business are not profitable. So we do think that will be a key source of funding going forward.
Okay. Can you go back to just your DCF model? I'm curious, you spent a lot of time talking about COGS as a percentage of revenue. Do you think that's the best way to model out a company that's in a commodity industry as far as COGS? As opposed to, the price of the gold can move up or down, so it's using a percentage of revenue means the best way to estimate costs.
Yeah, I understand your question. It may not be as accurate, but for the simplicity of this model that we were trying to achieve, I think it made the most sense. And we think that as the business grows, like I said, the new capacity and the new operations become more efficient, which results in a decrease in cost as a percentage of revenue.
Okay. And then, I see your weighted average cost of capital 5.6, but sorry if I missed it.
I have the breakdown here. So the weighted average cost of capital, the beta was 0.78.
Okay.
This information was from FactSet. The market risk premium was 4.72%, and then we used a risk-free rate of 1.79%. The company has a debt weighting of 2.5% and an equity weighting of 97.5%.
Okay. And so then what's the cost of equity that you used in aggregate then?
It's 5.6%. Or that's the way the cost of capital. I think cost of equity is lower than that because their cost of debt is like 7.9%. So.
Okay. Thanks. Can you talk about any of the recent company events that they've done, corporate actions that have maybe taken place, and maybe why they've done that with their share count?
I had mentioned that a lot of the recent CapEx, a lot of their funds were used for that new acquisition of the mineral property, which was $2 million.
Yeah, okay. And then they did a reverse split.
A reverse split, and they're changing the name and the ticker.
Okay, sure.
Because they're going to uplist, they're going to move up to a higher exchange, which will increase, I guess, the net that they can cast for potential investors.
I guess you guys are, go ahead.
I was going to ask if you're kind of using some rear view mirror analysis on the industry overview with respect to mining employment. I'm just curious if there might be any signs that employment could pick up there and what those might be. Did you consider that in your analysis at all?
Yeah, so one part of it is based off analysis I've done, there has been a turnover due to one is COVID-19, for example. It's it's given employees more time to contemplate whether or not this is the right field for them, for example. And now that that specific group is gone, mining companies are now looking towards the younger generation, but there's certain educational path that they have to go down, and that's kind of scarce right now. So I think for maybe the next 2 to 3 years, I do see it going up.
So may go.
Yeah, maybe, yeah.
There's also a strong correlation between the size of the industry, employment, and obviously the price of the underlying commodity. It is a very cyclical industry, so depending on your outlook on the price of gold, which for us, the meeting of the analysts that we looked at do project the price of gold.
Yeah, what are the drivers for that?
It's just kind of whatever each analyst chooses. A lot of them were reputable analysts from larger banks, and FactSet their information provider, and it takes those estimates and gives us a median, which we think that those analysts can do a much better job projecting the price of gold than we can, as we have all that industry specific knowledge.
Sure.
Thank you.
Yes, 2 questions. One, when you look at Idaho Strategic Resources compared to their peers, how does their capital structure differ, and what would maybe be the ideal capital structure for them?
I feel like for their capital structure, it has like the most of them, just junior mining companies in general, I feel like have to be financed through equity more, because since there is no positive cash flow in majority of junior mining companies, like if you take out a lot of debt, there's a significant chance of you going to default. So like I'm not entirely sure on the specifics of the capital structure of these 3 companies, but I do know, like, it would just make sense that most of them are financed primarily through stock issuances.
Okay, that's fair. And then as far as the price of gold, you guys are pretty bearish on this company. You're not a fan of them. You outlined a lot of important risks. Why not just own gold instead of owning the company outright, or the GLD ETF if you're buying this in your portfolio? Or maybe what would be
I would actually maybe invert that. If this is a sell, instead of shorting the stock, why wouldn't we short gold, since that's going down, according to the analysts?
Gold is very cyclical, and obviously, we are quite bearish according to our analysis. And I guess we would not want to either purchase or short gold. We don't want to have to hold gold. There's obviously holding expenses, but you can get exposure through an ETF.
Oh yeah, you
Not
the
necessarily
ETFs.
the same, but we do see a lot of shorter term complications with this company in particular.
And I do think regardless of the future price of gold, barring a 50% increase, the cost per ounce that IDR is paying versus just foreign competitors, I think that in and of itself, we're not necessarily bearish on gold itself, but just the cost that IDR has to go through to get gold out of the ground compared to foreign competitors outside of the U.S.
Provide some more detail on it. Their all-in sustaining cost in the last 9 months was $1,600 per ounce, and it has seen some improvement from about $2,000 per ounce in 2020. So they have seen some operational improvements there as the capacity and new mining becomes more lucrative. But that has paled in comparison to the cost benefits that a lot of foreign mining companies have in, say, Mexico, Argentina, or Chile, where they're able to reach an all-in sustaining cost below $700 or $800 per ounce.
Sure. Did you guys consider, there's a lot of different properties with this company, different assets. There's the Golden Chest mine, but then there's these other longer term opportunities. Did you attribute different valuations to any of those pieces? I saw your DCF work here, but did you, how much of the valuation do you attribute to Golden Chest versus the rest of the enterprise?
So the way that the DCF works is obviously a function of revenue and operating, and just due to the nature of the stage of their different assets outside of Golden Chest, the timeline to exploration to
And time.